Welcome to the WealthWise show. I'm your host, the Wise Investor. Join me today as we discuss many different financial tools that can be utilized in your everyday financial life. We discussed all sorts of things from financial literacy, financial education, just things and tips and tricks that you can utilize in your financial journey. So to get started, just want to have this disclaimer. This information is provided as general information and is not intended to be any specific in financial or tax guidance. Before you make any financial decisions regarding your personal finance situation, you should consult a financial or tax professional to discuss your individual circumstances objectives. So keep in mind, guys, this is for educational purposes only. This is not meant to be for you to use as your personal financial advice. So I'm not your financial advisor. Unless you are my client, then thank you for listening. So here we go for today's episode of the WealthWise Show. Alrighty, guys. On today's episode of the WealthWise Show, this is a good one. We got a question, and I'm going to elaborate more on the question, and not just give this person an answer, but go into a little more detail. So I got a question: what are mutual funds? Short answer: mutual funds are open investment companies, and open investment companies mean they continually issue shares. They're not a closed-in investment company where there's a set amount or number of shares. So a mutual fund is an open-ended investment company that continue to issue out shares, and the money that you give them, they put that money into other things like stocks, bonds, whatever the mutual fund agenda is. And, they put that money in there, and you own a share of the fund, and they typically are good at paying dividends, paying you, the shareholder, a piece of the pie. So got that out of the way. Super simple, like I said, but I'm going to go into more detail. And I also want to talk about the other type of fund, which I've talked about it before on this podcast. I don't remember which episode, but we talked about exchange traded funds, ETFs. Now, those are really popular, and you will see why. And some would say more popular than mutual funds. And like I said, you'll see why. But what are ETFs? Well, just like mutual funds, ETFs are a type of fund, meaning you're pulling money together and you are, using that money to buy stocks or buy things that whatever the fund objective is. Typically, these funds, you can buy them easily on any exchange. I wouldn't say any exchange, but yes, pretty much any exchange. That's what they're called, exchange traded funds. And the good thing about exchange traded funds is they're easily to get in and out of. And not to say if mutual funds are not easy to get in and out of, it just sometimes there are lockup periods depending on fees. So it's really not a lockup period. You can sell whatever, but some funds may charge you if you sell early, or they might waive a fee, I should say. And if you sell early, then you end up having to pay that fee. But let's get into the first thing, which is mutual funds. So like I said, we talked about what are mutual funds. We talked about that, the definition of that. I kind of explained how mutual funds work. Typically, like I said, it's a pool of money and you're buying a share. Typically, mutual funds are professionally managed. So they have portfolio managers who, do their due diligence on whatever their objectives are. And typically some mutual funds are very diverse, and they're usually a lower risk than, just owning one particular company or anything like that. And mutual funds are typically more affordable. They have a low initial dollar amount for investments or even continual purchases. And like I said, the liquidity in mutual funds, they're liquid. You can sell your shares or whatever. But like I said before, some mutual funds, waive their fee, because there is a fee. And if you hold it for a period of time, and then after that period of time, you can sell without a fee. But sometimes if you sell earlier, depending on whatever they've stated, you have to pay a particular fee. So what are some of the types of mutual funds? Well, just like ETFs, there are a number of funds. You have your low risk type of funds, which are money markets. Like I said, they're low risk. So like I talked about in the very first episode by bonds, money markets are typically, high quality, short-term investments. And they're usually, issued like bills, treasury bills issued by, the government. And local government. So they're typically high quality, like I said, and they're short term. So, and they're relatively low risk. So that's what a money market fund is for a mutual fund. So, you want that for someone who, if you're looking for like income, and, you don't want to have too much risk in the equity market, then, typically you'll go with a money market mutual fund. And then the next type of fund is one of my favorites, bonds. It's a bond fund. So the difference between the bond funds and the money market funds, because the money market funds typically do invest in, investments issued, typically debt, and bonds are technically debt, but these have a little bit more risk than the money market funds, because they do try to have a higher return. So, usually bond funds are more focused on that relatively safety, low risk, than a stock fund, but they still are trying to have different types of bonds in there. So, they may have corporate bonds, which is debt issued by corporations and mixed in with some U.S. Treasury, mixed in with some other municipals, maybe even international bonds, things like that. So even though bonds are typically lower risk than equities, they're still a little bit more riskier than money market. So the next fund is a stock fund. Very simple. This fund, type of mutual fund, typically is going to invest in corporate stocks, equity. And there are sub funds in the stock mutual fund arena. You have growth funds. I remember we talked about this not too long ago, how growth funds, growth companies, are usually companies that don't pay a dividends, or at least don't pay a regular dividends, and they have a high potential for growth in the future. So you can get funds to focus solely on companies like that. Then you have an income type of fund where these mutual funds invest in companies that pays a regular dividends. Then you have your index funds. Usually these mutual funds, they attach themselves to an index, like the S&P 500, and try to, track their movement by basically investing in whatever the S&P 500 invests in. And then you also have sector funds. I think I mentioned this one of these episodes, But sector funds are essentially funds in the different sectors. So you have energy. So energy stocks are like, your oil, things like that. So you got energy stocks, you got utility stocks, you got healthcare, you got tech, you got consumer staples, consumer discretionary, you got financials. So these are funds that are going to specialize in a particular sector, a particular industry. And so if you have, some money market funds in your mutual fund portfolio, you have some bond funds in your mutual fund portfolio, you can mix in a little, get a little more detail with your diversity and, say, hey, I like financials. I work in banks. I've been a banker my entire life. I love financials. And I'm saying this is me, because I'm in finance, but I'm not a banker, nor have I ever been a banker. But let's say someone who is, they're like, hey, I got all this stuff set up for my portfolio. I want to be more detailed. I want finance sector or tech. I'm a techie, so I'm like, I love technology. I love the innovation and growth. So I'm going to invest in this, fund that puts their money into stocks or stocks that are tech heavy. So those are pretty much the subsectors of a stock mutual fund. Now, there is another type of mutual fund. It's called a target date fund. Now, what is a target date fund? Well, it's a mix. Typically, it's a mix of stocks, bonds, and typically other types of investments. And then gradually over time, they might mix their strategy. They might mix their strategy up, and typically target dates funds can be known as like life cycle funds. So they're usually, are good for people who have, like, let's say, a retirement planning. So it's really good for like a retirement planning tool, essentially. So those are the different types of mutual funds there are. Now, what are the benefits and risks of mutual funds? Well, I'm going to go ahead and preface this now. Mutual funds, not all of them, but a good chunk of them do carry low risk. They're not as aggressive. Some of them, not all of them now. Don't quote me on all of them. But a lot of them are not aggressive. And the benefits of a mutual fund is, they are professionally managed. A lot of them have diversification, and they're good for diversifying your portfolio. They do offer ways you can earn money. You can do dividends payments. So any income that the fund makes, it will disperse that income to the people who own the shares. So they will pay you dividends. They also do capital gains distributions. So if the securities in the fund, it grows, well, they may sell some of those securities to, collect the capital gain of that and distribute that to the people who owns, the investors who owns the shares. So there are some good benefits for owning mutual funds. But what about the risks? Well, just like any investments, there is a possibility of losing money that you may have invested. So that's why doing your due diligence is important. Nothing is guaranteed, but that goes for anything in the markets, anything in life. So in a lot of times they do have another risk is fluctuating dividends. So unlike fixed income where it's fixed, so let's say a bond is fixed at a certain interest rate. Well, a lot of times mutual funds, depending on how the market is doing or where they're investing in, the dividends or interest payments may fluctuate. And past performance doesn't mean you're going to get those returns in the future. That's important. Past performance does not mean you're going to get those same returns in the future. But that's like with anything. If you look at AT&T, the stock, they were doing really great back in the day, but now they're not. So yes, we can use history to kind of get an idea of what may happen in the future, but nothing's guaranteed. It doesn't mean it's 100%. And a lot of times, mutual funds are low volatile a lot of times, but there is some investment risk. So just keep that in mind. And one of the things about mutual funds too is they do charge fees, but so do a lot of other things, which we're going to get into in a second. But typically the fees, are pretty minimum depending on what you're investing in, which mutual fund. So make sure you read the prospectus, which I'm going to give you the definition of that, because you said, what do you just say to me? I'm going to give you the definition. But make sure you read the prospectus and figure out what the fees are. Typically the fees are not too much, and the more money you put in these funds, you will be entitled for what called a breakpoint sale, meaning you get a little discount on the fees. So just keep that in mind. And you can even do a letter of intent, meaning let's say you say, hey, I got 10 grand and I need 15 to get this breakpoint sale, so I can lower my fees. Well, you can do a letter of intent stating like, hey, give me 6 to 12 months and I will have the other 5 grand, and and then they'll go ahead and honor that for you. But you also have to honor your side by giving the 5 grand. And I believe if not, you just end up paying the fees. So that's pretty much what mutual funds are. I hope I broke it down and simplified it for you. And if you have more questions on mutual funds, Google is your best friend. Google mutual funds, and you're just gonna read what I just said, or just replay this. I can definitely use the replays. So let's talk about exchange traded funds. So just like mutual funds, exchange traded funds are funds. You pull your money together with other investors, and you have typically they're managed. A lot of times they are managed, some actively managed, I should say, and they do almost similar to what mutual funds do. But the difference is that they do, you can buy them on any exchange for one. And I didn't talk about the NAV, but because it's not complicated, but it's a little complicated to explain in a podcast. But a lot of times with ETFs, you can purchase or redeem, your shares, I guess, at the end of each trading day at the NAV price. And the intraday trading feature of closing funds, a lot of those shares are market price. So a lot of times with ETFs, they're kind of on a supply and demand type level. So if I want to, I can buy a bunch of ETF shares and fluctuate the price. But unlike mutual funds, really, you retail investors can, like I said, you can buy them on the exchange. You can buy and sell them. You don't need to go through your money manager. Technically, mutual funds, you can technically do that too on some brokerages, but not all of them. Like you can't buy, I don't think you can buy mutual funds on Robinhood. Don't quote me, but I don't think you can. but you can definitely buy some ETFs. I know that for a fact. They have options. A lot of ETFs have options. And there is an episode coming on options. So if you don't know what options are, just know it's another option that you can use in the markets. So there are many different types of ETFs. Like I said, some of them are actively managed. So they're not, on a index or trying to follow an index. They are typically, managed by portfolio managers, and whatever the prospectus, whatever the, what's the word I'm looking for? I don't want to say requirement, whatever their goals are. That's a good one. I was trying to find a big word, but I'm stumbling over myself. So whatever the ETF goals are, that manager is going to do its best. And to go back really quick, because I think I messed up on something. When I was talking about some of the features of the ETFs, I was talking about the NAV. I was talking about NAV really with mutual funds. They have that, and ETFs have like market prices. So you can, it's a little more easy to get in and out and understand how much it is and all that stuff with ETFs. But like I was saying, actively managed ETFs are ETFs that, they're going to have managers dealing with your portfolio or with their portfolio, and you're giving them money to go do stuff with their portfolio. But then you also, just like mutual funds, have index-based ETFs. One of the popular index-based ETFs are the SPY. I'm not endorsing SPY. I'm not saying go buy SPY. I'm just giving you an example of an ETF that's index-based. So they're going to track the S&P 500, which SPY does, and SPY does it really close. But just like mutual funds, you also have index based funds. So and some of the considerations that you might want to think about when investing in ETFs is there are a few differences from mutual funds, and a lot of times those differences can be a lot more easier to understand, like market price or price per share, and things like that, and finding that you can go in any app and purchase ETF shares, and the market transactions for purchasing or selling ETF shares are a lot easier. And the only thing too is I would feel like ETFs do fluctuate a lot more than mutual funds. So you gotta, that's the caveat with ETFs is, yes, they have that diversity of a mutual fund, but it can also have that fluctuation like a stock, like a actual corporate stock. So those are some of the things you might want to think about when purchasing an ETF. But one of the most important things is understanding and reading the prospectus. Now, I said I was going to explain what a prospectus is. Essentially, a prospectus is included with majority, if not all, exchange or pretty much investments. Any kind of investments like mutual funds has a prospectus, stocks, IPOs have prospectus. ETFs, when they IPO, they have one, and pretty much it's just a document that states the objectives of the whatever they're doing, the risks, the fees, the expenses, and pretty much any other information that you will need as the investor when you're considering investing in this fund. So a lot of people don't read those, but it is important to at least look over it or have your money manager read it, or because that's going to give you that's going to answer a majority of your questions when it comes down to an ETF. And you notice I said expenses and fees. Well, ETFs do have expenses and fees. I know a lot of people don't know that, but they do. If you were to buy the ETF SPY, let's just SPY is easy. If you were to buy a share of SPY, well, you do have to pay a very small percentage, like a really small percentage to them for managing that portfolio for you, essentially. I'm trying to figure out how much is their fee. So their fee as of right now is 0.09%. So that translates to, for every $10,000 invested, you pay, $9. So that's their expense ratio. So even though it's not a lot, it's very small, but you still have to pay something. And a lot of people don't know that. And the more money you're putting into these companies, especially over time, you have to be more cognizant of the little things that you get nickel and dime for. If it's something that you can like, okay, yeah, I can pay that, that's fine, but at least be aware of it and understand that you're paying it. And because you're paying it, talk to your CPA about it. I'm not a CPA, but definitely talk to your CPA about your expenses when it comes down to owning ETFs or mutual funds. So you guys understand what perspectives is? I'm assuming you said yes. You guys understand what a mutual fund is? I'm going to assume you said yes. And ETFs. Any questions? All right, no, I don't hear any questions. Great. So also I want to hammer home this point. When you're investing, always understand that you need to ask questions. I know I keep talking about that, but it's important to know what you're spending your hard-earned money on and who you're giving your hard-earned money to. So even when seeking professional advice, it's important to ask questions. And if they get annoyed with you asking questions, not going to say they, don't know what they're doing, but I am happy to talk about finance. Like, this is my job. I love what I do. So I ask any questions, I'm going to answer it. If I don't know it, I'll be honest, say, hey man, I don't know, but let me get back to you. And that's because imparting wisdom and imparting knowledge is my job as an advisor. And I said that again to emphasize the advisory part, because my job is to advise. And if you don't have a wise advisor in your corner, then what do you have? And so understand the importance of asking questions, seeking professional help, asking them questions, and comprehending the investment opportunities that you are presented with. And when you're considering the advice of an investment professional, do a little bit of your own research just to confirm what they're saying, and understand that aligning your investment objectives goes hand in hand with your risk tolerance. So if you see and you hear on the news or CNBC and they say Nvidia just went up 150%, that sounds great, but can your heart handle that? And you might say, well, yeah, the wise investor, I can definitely handle 150%. All right, but can you handle if it goes down 50%? And I'm talking about 50% of principal of your actual money, no capital gains. So your investment objective may be to make money, but your risk tolerance says, no, slow down there, Jeffro. We need to think about this. So those are, my imparting wisdom words or wise words. I really hope, you guys are taken to this podcast. I believe this is the 5th episode. Getting a little more comfortable. And I, going to have the video. I know I said that for like the last couple of weeks. But bear with me. I just ordered some stuff. It's coming to the house. I got to set it up. I got to test it. I got to, do all sorts of stuff with it to make sure I'm giving you guys the best I can give. So, that wraps up another enlightening episode of the WealthWise show. I really hope you gain valuable insight and practical tips to take control of your financial future. And remember, financial education is a journey, and I'm right there with you. If you have any questions or topics you'd like me to cover, feel free to reach out to me through my social medias, YouTube, Instagram, Twitters, anything that you might see me on. Reach out, even in person. If you see me on the street, even though you don't know what I look like, reach out. Don't forget to subscribe to my podcast on YouTube, Spotify, wherever you listen to podcasts at. Subscribe, like, comment, help me out. That'd be great. And together, let's unlock the doors to financial independency and live our best lives, guys. Until next time, stay WealthWise. Investment advisory and financial planning services offered through Simplicity Wealth and SEC Registered Investment Advisor. Sub-advisory services are provided by Simplicity Solutions, LLC, a registered investment advisor. Any insurance, consulting, and education services offered through the WealthWise Show. The WealthWise Show is not affiliated with Simplicity Wealth and Simplicity Solutions.